All right. Today is Sunday, April 10th, and this is a recap of the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, and let's dive right into it. In focus. The inflation crisis is morphing into a global political chaos. We start with the breaking news that we got over the weekend. Imran Khan, the Prime Minister of Pakistan, poof, gone. Why is he gone? Well, let's track the events from the beginning. Back in February, when Russia just invaded Ukraine, the Pakistani leader Khan visited Russia. He visited Moscow and met with Putin to secure new deals, specifically gas pipelines. This was part of cementing the relationship between Pakistan and Russia. Of course, in recent years, it's not just Pakistan, but even India got closer to Russia. And the reason is the United States lost leadership in that particular region. These two countries, India and Pakistan, wanted weapons, they wanted technology, they wanted financial support. We did not provide any of that, but the Russians did. So it is no wonder why both India and Pakistan, by the way, these two guys don't like each other at all, but they got something in common, which is getting closer to Russia. Now, it was predicted, it wasn't a surprise, by the way, that Pakistani leader Imran Khan was going to face consequences for the visit to Russia, specifically from the United States. Now, there are plenty of conspiracy theories, and the Prime Minister, or shall we say former Prime Minister now, is also echoing the same conspiracy theories, that U.S. intelligence services were behind his ousting from the government. Now, make no mistake, Khan is not going to go down without a fight. He's going to go down swinging, and his supporters are already filling the streets, protesting from Pakistan to London, all over the place. So this guy is not going to go down without a fight. But, conspiracies aside, what was the real reason, or shall we say the key, behind the ousting of Prime Minister Khan? Well, how about this? Last Thursday, the Pakistan Central Bank announced an emergency meeting in which the bank issued a surprise announcement of hiking interest rates by 250 basis points to a rate of 12.25%. Folks, here in the United States, we're already pissing our pants and wasting a lot of diapers, fearing that the Fed will increase interest rates by 50 basis points in the May meeting. In this case, we're talking about a bank that increased interest rates by 250 basis points in one meeting. Why would the Pakistani Central Bank do that? Here's the answer. How about inflation? Inflation is sky high in Pakistan, specifically food inflation. When you have the population paying more for food, for gas, for bills, and they're struggling to catch up with inflation, prices across the board are rising around them. And on top of that, we're now facing food inflation and massive shortages due to the war and other reasons such as sanctions and the reckless policy by the world's central bank, the Federal Reserve. So again, we can talk about the conspiracy theories, and perhaps Mr. Khan was ousted due to his visit to Russia. Maybe the United States wanted to send a message to all of these countries allying with Russia, and they picked on Pakistan because it was the easiest target versus, let's say, India or Saudi Arabia. But in reality, ousting the Prime Minister was not possible without sky-high inflation and public outrage due to that inflation. And in any country, the public always blames whoever is in power for the economic woes, in this case, inflation. The Pakistani public is outraged by this inflation, and the ousting of Imran Khan was not possible without inflation being the background of the story. And the problem is, it's not just going to be Pakistan, by the way. The dominoes are falling globally. Why? Because food inflation is reaching all-time highs. We've never seen food this expensive before. Furthermore, we are seeing what's going on in Peru, for example. Mass protests, state of emergency. The army is now called to beat protesters on the streets of Peru. And the scenes are getting ugly. People are wondering, are they going to eat tomorrow or not? Are they going to be able to afford eating or not? Farmers are complaining about the prices of fertilizers. There is a massive labor strike in Peru, and it's getting uglier by the day. And of course, the population is blaming whoever is in charge. In this case, the Castillo administration. Now, I don't know anything about the politics of Peru. I don't know if this guy is good or bad. Is he responsible for inflation or not? But this is what I know. I know that inflation is a global phenomenon. Why? Because inflation has always been a monetary phenomenon. When you have commodities worldwide priced and traded in US dollar, who is in control of inflation worldwide? The answer is the US Central Bank, which happens to be the world's central bank, the Federal Reserve, the root of all evil. And I talked in this program, by the way, last year, and I said the Fed is committing the crime of the century. Why? Because this inflation crisis is going to morph into a starvation crisis, and it's going to morph into massive public unrest worldwide, which will cause wars and change governments, and perhaps cause revolutions and mass destruction and disruption worldwide. And hence, the Fed is committing the crime of the century. And why did they commit the crime of the century? Easy. To prop up the stock and real estate markets to make the rich richer, and to initiate the biggest transfer of wealth in human history. And we're now seeing the ramifications of all of that. The rich and the insiders cashed in billions of dollars from the crime of the century. They're now sitting in their super yachts, private jets, mansions all over the country, all over the world. But we're seeing the ramifications of the crime of the century for the poor and the middle class worldwide. And this is just the beginning, folks. What we saw in Pakistan, what we're seeing right now in Peru, what we're seeing, by the way, in Sri Lanka too, where we're seeing massive protests. This will be contagious, and it's not just going to be limited to Pakistan, Peru, and Sri Lanka. Why is Pakistan and Sri Lanka falling apart right now? The answer is inflation. Inflation is sky high. And the question is, who's next? Is it going to be India? Is it going to be the Philippines? Is it going to be Korea? Or is it going to be European countries? Is it going to be Turkey, for example? Look at the inflation rate in the country of Turkey. 61%, the highest inflation in 20 years. Energy alone went higher by 100% year over year. Food in Turkey is up over 70% year over year. You really think we're not going to see mass uprising in the country of Turkey or whatever comes with that? Civil war, perhaps? You think Erdogan is going to let go of power easily? Of course not. Look at what's going on in France. You have an election right now, and Macron barely made it. And now the globalist tool will be facing Le Pen in a runoff election, and everybody's scared that Le Pen could make it and Macron could lose due to inflation rising significantly higher in the country of France. Likewise, what about Germany? Chancellor Scholz just made it. He could be ousted just as easily because douchebag is now warning of inevitable recession in Germany if Russian energy is cut off. Furthermore, douchebag also adds that the gas rationing in Germany could cause structural damage, quote-unquote, to the German economy. On top of that, this Russian war with Ukraine is going to cost the German economy a dire cost that could morph into a political cost because inflation is sky high in Germany. We're seeing Weimar Republic-like inflation when we talk about the pace. Soon enough, will the German public tolerate this kind of inflation? Who are they going to blame? Putin? Jerome Powell? No, they're not. They're going to blame the guy right in front of them, and that's going to be Chancellor Scholz. And there is a reason why Scholz was a little shy in the beginning in punishing Russia, because he knew the German economy is going to collapse if he takes a harsh stance against Russia, and he will pay the price for that politically. But then the Chancellor had to bow down to American will and pressure and took a harsh stance against Russia, which the German economy will pay a dire price for, and perhaps the Chancellor will also pay a dire political price for. Look at what's going on in the German economy, specifically in automobile manufacturing, which is the crown jewel of the German economy. BMW is now halting production at 2 German factories. Mercedes is also slowing down work at its assembly plants. VW is warning of production stoppages, and it's looking for alternative sources for parts. Why? Because the majority of these parts, a lot of them at least, come from Russia and Ukraine. On top of that, we have severe inflation in materials prices either way, be it iron, be it copper, be it aluminum, be it nickel, be it palladium. All of these prices are surging higher due to inflation, and on top of that, we have the war. So the question is, will the German government be the next domino to fall? How about the US government? How about the Biden administration? Would that be the next domino to fall? From what we know right now, the Biden approval ratings are dropping like a rock, like never seen before. Matter of fact, Biden approval numbers are now at all-time low. We have never seen an administration this unpopular at this stage of the presidency. What about California? Could that be the next domino to fall? We know King Dracula, Kim Jong-un Newsom, is pretty much endangered species right now. Even Bill Maher says that California could flip red because people cannot do effing anything. I could run against Newsom right now and I can flip the state. That's how easy it is. All you have to do is talk about homelessness, inflation, crime, waste of public funds. Californians right now are hungry for change. But is the Republican Party seizing the opportunity and providing the public in California with an alternative, a viable candidate, somebody we can get excited around? Of course not, because the Republicans, just like the Democrats, are a bunch of cowards and sellouts to the big corporations and the 1%, the oligarchy. They're exactly the same, but this is how dire the situation is. People are going to hold their noses again and vote for King Dracula. Why? Because there is no alternative. What are they going to do? What's going to happen to California if Newsom secures a second term, for example? It's going to be utter chaos. Inflation is already out of control. The majority of Californians cannot even afford a home or rent. What is Newsom's solution, by the way? Bribing the population, buying the elections. He's going to hand $400 for each car. Each car you own, up to 2 cars, you're going to get $400 each. But make sure you vote Newsom this elections, right? Even the Democratic Party is now bribing Americans because they know they're going to be endangered species comes November. They're now bribing Americans with $100 a month as relief to the skyrocketing prices at the pump. All I have to say is, good luck. And now, even Lawrence Summers is now predicting that the majority of economists sooner or later will come around the recession consensus, that the U.S. economy will fall into a recession sooner or later, perhaps before the end of the year. Inflation forecasts are rising by the day. They're being revised higher and higher and higher. And in this channel, we predicted that exactly. Look at the April survey, for example. In Q1, inflation will be at around 8%. The February survey put inflation at around 7%. In Q2, the April survey says that inflation will go down slightly, but it will still stay at around 7%. And I say, hold your horses here. Inflation is going to go to double digits before you know it, unless the Federal Reserve acts and start raising interest rates seriously. 50 basis points, not gonna make it. You need the shock and awe approach. And then you can play the psychology game of easing if the economy starts to fall apart rapidly. But do you think the zombies at the Fed can think like that? Of course not. So what's going to happen in the meantime? The Fed will be shy, raising interest rates by 25 basis points at a time. What's going to happen? The consumer will continue to swipe those credit cards up and down, up and down, up and down to chase that inflation. Consumer credit went higher by almost $42 billion in a month, and it's about to get a lot worse. If inflation doesn't cool down, we will see the consumer continuing to chase this inflation by racking up more debt. What's going to happen when the recession, the inevitable recession, by the way, happens, and these people lose their jobs? And now the debt, the mountain of debt that they're racking up, well, the interest rate on that mountain of debt will move higher and higher and higher. We will see foreclosures, we will see bankruptcies, we will see disasters in this economy. Why? Because the Fed refuses to take action now. They continue to be behind the curve. They continue to be so callous about the crime of the century that they committed. And now even the market, by the way, is expecting a more aggressive hiking cycle because the market is saying the Fed has no other choice but to conduct the most aggressive hiking cycle since 1994. We will see if the Fed follows through with that or not. For now, from what we know from their speeches, all of these zombies, they're talking tough, but their actions remain behind the curve. Meaning, if I'm right, they're going to continue to be shy about increasing interest rates because, God forbid, the stock market could go down. And then they're going to play catch up later on by increasing interest rates aggressively all at once, which will ensure that this country will fall into a massive recession. Look at the 10-year yield, for example. It is breaking a multi-decade downward trend, which means in the worst case scenario, we could see the 10-year yield skyrocketing to double digits. And if that happens, what do you think will happen to the outstanding debt on credit cards, for example? The interest rates will be what, 100%? What will happen to the housing market when mortgage rates also go out of control to maybe 10, 15, 20, if not more? Folks, what we saw in Pakistan over the weekend, what we're seeing right now in France, in Peru, in Sri Lanka, and soon enough Germany and other countries, this will be contagious. We will see governments falling apart. We will see riots and uprising and even starvation in some territories. Thank you to the Federal Reserve. But rest assured, UBS says that inflation has peaked. It already peaked. It's done. It's over. But warns that the March Consumer Price Index will still be really nasty. Oh, really? Matter of fact, UBS says that this CPI reading we're about to get this upcoming week will be at around 8.5%, but that will be the peak. And after that, we will see inflation going down to 8, 7, 6, and all the way to 3.4% by the end of the year. And I say good luck, because for that scenario to happen, the Fed must act right now, and they must act aggressively. What does that mean? Forcing a recession on the economy. That is the remedy, and it's the only reason inflation would go down. Dark times ahead, folks, but the lesson of the day is you must be prepared. How can you be prepared, by the way? Using this insane bubble that we're in right now, this insane inflation, to accumulate as much wealth as you can. You can still do that in the stock market, but by being in the right corners of the stock market, not chasing the same old that is not working anymore. And then you have to also start thinking about paying down your debt, your credit card debt, cleansing yourself from all of these obligations that you don't really need. If you have a rent that you cannot really afford, it is time to rethink that. If you have a mortgage that you cannot really afford if you lose your job, it is time to rethink that. The bottom line is, number one, you gotta accumulate as much wealth as you can from this bubble, this insane mania. Number two, you pay down your debt, because when interest rates move higher, that debt will cost you more. Number three, have at least a 9-month cushion in case you lose your job, because there is no recession without job losses. So if you think that your job is in the bag, think again. Do you have the savings to pay your rent, your grocery bills, your utility bills, your gas bills, your monthly expenses for at least 9 months or not? And if not, you gotta start working on doing that right now. So 3 steps, folks. Accumulate as much wealth as you can. Number 2, pay down your debt. Number 3, accumulate savings of at least 9 months worth of monthly expenses, and you will weather the storm, and you're going to be just fine, because there's going to be a time where we have to buy all of these assets at a cheaper price. And the question is, will you have the capital to do that, to scoop up all of these homes, cars, stocks at a cheaper price, when all of these morons with the FOMO chase the market and pay top prices, and when the recession happens, they're going to have to dump all of these assets. And you, because you're prepared already, you're going to be able to scoop all of these assets that they're going to dump, be it houses, be it cars, be it stocks, be it otherwise, at pennies on the dollar. Anyhow, folks, we're going to move on here and cover the market information for you. We start with the performance of indices last week, and here we go. On Friday, the Dow Industrial Average closed in the green, up by 137.55 points, or a gain of 0.40%. The Nasdaq, on the other hand, was down 186.30 points, or a decline of 1.34%. Likewise, the S&P 500 was down by 11.93 points, or a decline of 0.27%. The sector's performances on Friday: number 1, capturing the gold medal, energy. Number 2 for the silver, financials. Number 3 for the bronze, materials. On the other hand, the laggards of the day were led by technology, cyclicals, and communication services. Let's contrast all of this with the weekly performance for the sectors of the market. At number 1, capturing the gold medal, healthcare. At number 2 for the silver, defensives. Number 3 for the bronze, energy. The laggards for the week led by technology, cyclicals, and communication services once again. What about the advance to decline ratios on Friday? NYSE 49% advancing versus 48% declining. The NASDAQ 33% advancing versus 63% declining. And by the way, we're now starting to see more 52-week lows. 159 new 52-week lows in the NASDAQ versus only 39 new 52-week highs. The breadth is getting awful once again in the NASDAQ. Moving on to commodities. On Friday, it was a good day across the board. Energy commodities gained significantly. The WTI and Brent closing the day with gains of almost 2% apiece. Gasoline was up almost 2.5%. Heating oil was up a little over 1.5%. The laggard in energy commodities on Friday was natural gas, which is, by the way, the winner for the week. But regardless, on Friday, it was down a little over half a percentage point. What about softs? On Friday, we saw gains across the board with exception of cotton. Cotton was down a little over half a percentage point. But look at these gains. Lumber closing the day with gains of over 6%. Sugar over 2.5%. Coffee over 2.75%. OJ closing the day. The rally in OJ, by the way, is unbelievable. And OJ closed the day with gains of almost 4% on Friday. Likewise, cocoa also closed the day with gains of almost 2.25%. Metals were in the green on Friday, be it gold, silver, platinum, copper, palladium, all in the green, but the majority of the gains came from palladium, an outstanding rally on Friday, gaining almost 9% in a single day. Meats not moving a lot, pretty much in the flat line across the board on Friday. Grains, on the other hand, gains across the board with exception of rough rice. Rough rice was in the red on Friday, but look at these gains. Wheat up almost 3%, oats up over 2%, soybean oil up almost 3%. You get the picture. Inflation is not going to stop anytime now. And here are some commodities news for you. Lisa Bromowitz from Bloomberg says oil prices are almost back to where they were before the Ukraine war, but for the wrong reasons. Pay attention now. Nations are taking emergency measures to flood the market with more supply. But demand may also fade in light of tighter monetary policy and China lockdowns. So once again, the release from the SPR was misguided because what if the Fed and China are going to do the job in lowering oil prices? I doubt it. I think we have higher highs in crude, but for now, the pressure is on. The problem is, sooner or later, when we get to the summer, we will realize that the Fed is still way behind the curve and the demand is coming back for oil, so we could see the highs this summer. It's not just me, by the way, saying that. It's JP Morgan, the biggest commodity manipulator on the planet. And JP Morgan says expect a 40% rally in commodities because investors are not going to buy the dip in stocks when the Fed is tightening. They're going to buy the dip in commodities until inflation is hit. And aside from oil, we're seeing nickel prices, for example, surging higher again. Even after London killed the volume by suspending trading of nickel. It's not working so far. Nickel prices are moving higher. And you might have heard the story that Elon Musk complained about lithium prices surging out of whack. And he's now suggesting that perhaps Tesla will get into the mining business to relieve the pain from the surge in lithium prices. Likewise, when we talk about grains, we're seeing China. This war has significant impacts, by the way, in the supply chain because China is now buying more corn from the United States, but we know that American farmers are not planting more corn. So this is a smart move by China to hoard whatever corn we have left. And the question is, will the American people have any corn left, say, next year? That is something to think about. And now we're seeing problems with wheat because Africa, the Middle East, specifically Egypt, is a huge importer of wheat from Russia and Ukraine. Well, now that's a no-go. What are they going to do over there? Starve or get more supplies from India, China, US, South America? This is what the Egyptian authorities are trying to do, but there is a problem. There is a shortage of fertilizers. So even if the Brazilian farmers, the Argentinian farmers, the American farmers, Canadian farmers, doesn't matter. They cannot plant more wheat to meet the Egyptian demand, and the reason is the shortage of fertilizers. The majority of these fertilizers come out of Russia, and we now have a sanction regime against any imports out of Russia, which is causing fertilizer shortages and massive price inflation. What does that mean? Where will the Egyptians find wheat if the farmers in India and China and Canada, US, South America cannot afford fertilizers, and they're planting soybeans, for example, instead of corn and wheat? Are we about to see a new Arab Spring in Egypt, for example? And if that wasn't enough, We now have a new strain of flu, bird flu, which is impacting millions of poultry worldwide, by the way. They're getting rid of chickens and birds across the globe because once you have one bird infected, you gotta get rid of all of them. And we're talking about millions of chicken and birds gone. And as a result, poultry and eggs prices are skyrocketing again. So we cannot catch a break. You could say stop eating beef and pork because we have shortages and price hikes in those. Okay, so we're gonna eat chicken. Now we cannot even eat chicken or eggs because we have a new flu strain. What do we eat then? Grains? Corn? Nobody's planting corn. Nobody's planting oats. Nobody's planting wheat. What do we eat now? Soybeans? Because that appears to be the only alternative available right now. And all of this inflation, by the way, is making the American dynasty of farming and agriculture, the Cargill family, richer than ever before. Once again, thank you to the stupidity of the Federal Reserve. Moving on to options, the big casino. What happened on Friday? Well, the hottest table by far was Apple at around 1.1 million contracts traded for the name. About 56% of those were calls. And at number 2, Tesla, the souffle, at around 1 million contracts traded. Around 60% of those were calls. And at number 3, AMD, with a little over 600,000 contracts traded for the name on Friday. About 65% of those were calls. They're not going to stop here, folks. They're buying calls in Tesla, AMD, Nvidia, AMC. Just put your blindfolds on and play the same plays that were hot about 2 years ago. Time for an update, folks. You cannot keep doing the same thing over and over and over again, expecting different results. Nvidia, AMD, AMC, Tesla, they were hot trades in 2020, 2021. Not anymore. Moving on to the unusual activities that took place in the options market on Friday, we start with the ticker NIO. Now, we have bad news for NIO because they're halting production in China. Why? The shutdowns in Shanghai. On top of the shortages in materials and supplies, this is bad news, very bad news for NIO. Yet somebody did not get the memo and they bought calls either way. Yet on the other hand of the trade, by the way, somebody's selling calls. Yet from the buyer's perspective, they bought the 21 calls for the expiration date, May 6, with expectations that the name could move higher by more than 5% by then. They paid around $1.50 a piece to enter this trade, all in all, spending around $3.5 million. What about the trade for the ticker SPY, the S&P 500? They're buying puts here, the 395 puts for the expiration date, May 13th, with expectations that the name could go down by more than 12% by then. They paid around $1.35 a piece to enter this trade, all in all spending around $1.7 million. What about the trades for the ticker TLT? Well, they're now getting the memo to short the TLT after it's already becoming oversold, but we have a put spread here. They bought the 113 put and they sold the 108 put, all for the expiration date May 20th, with expectations that the TLT could go down by over 9.5%, but not more than 13.5% by then. They paid around 60 cents a piece for opening the 113 puts, and they received around 20 cents a piece as credit from selling the 108 puts. All in all, they're spending around 40 cents a piece, bringing the total for this trade at around $450,000. What about the trade for the ticker CEG, Constellation Energy, a winner for the year, up over 50%, and somebody's bidding for more gains to come by buying these $70 calls with the expiration date May 20th, with expectations that the name could move higher by more than 9% by then. They paid around $1 a piece to enter this trade, all in all spending around $850,000. Continuing with interesting trades, what about the trade for the ticker TDOC, Teladoc? They're buying calls, interesting, the $70 calls for the expiration date May 20th, with expectations that the name could move higher by more than 6% by then. They paid around $5 a piece to enter this trade, all in all spending around $2 million. And lastly, what about the trade for the ticker XLU? This is the utility ETF. It's not a good trade, by the way, because the spread is wide, but the point being here is somebody's shorting the XLU. Utilities have been rallying significantly, but we know that utilities are substitutes for bond yields. What happens when bond yields surge significantly higher? And now you have, let's say, the 2-year yield paying you 2.5%, 3%. And then you have a utility stock that pays you 2.5%, 3%. Which one would you go with? The risk-free 2-year note or the utility stock? And you assume the risk of that stock going down. Well, the answer is clear. You're going to go with the note, the risk-free one. And perhaps this is the reason behind this trade of shorting utilities, because somebody bought the 70.5 puts for the expiration date, April 29th, with expectations that the XLU could go down by more than 8.5% by then. They paid around $3 a piece to enter this trade, all in all spending around $1 million. Moving on to the heat map analysis. This is the heat map on Friday. The majority of the pain was in industrials and the northwestern side of the heat map. The technology stocks, chips, software, big caps, the Chinese names, the cyclicals, even Tesla was down 3%, so a lot of pain in the retail favorite side of the stock market. But we got gains where? In the commodities side of the market. Energy, agricultural names, Mosaic, Nutrin, ADM, Kroger in defensives, even Deere, the only shining light in industrials. We got gains from the big pharma names, the outperformers for the week, by the way, and most importantly, some short covering activities in financials ahead of earnings this upcoming week. Let's contrast all of this with the weekly heat map, and again, lots of pain in financials, technology, communication services, the cyclicals down big. Look at the autos, even Tesla's down almost 5.5% for the week. The pain in transportation, stunning pain, whether we're talking about UPS, down over 7%, the railroads, the airlines, even Boeing was down big. We'll talk about Boeing in a second, but the winners. We have the big retailers, Home Depot and Lowe's. By the way, bad news over the weekend for Home Depot. A big fire in San Jose pretty much destroyed an entire store of Home Depot. But we're seeing the defensives working out. Walmart, Procter & Gamble, the staples, the year-to-date winners, Kroger, ADM, Energy, the fertilizer names. It wasn't a good week, by the way, for the rest of materials. For example, FCX, copper was down, Alcoa was down, steel stocks were down, but fertilizers were hot. Why? Because of the rise in natural gas prices. Likewise, the ultra-defensive names in utilities and REITs were also in the green. In industrials, the outlier are the defense contractors. Lockheed was in the green for the week. But the winners by far were the big pharma names, the big insurance names. We're talking about Pfizer, we're talking about AbbVie, we're talking about Eli Lilly, we're talking about Abbott Laboratories, we're talking about United Health. All of these names were up big for the week. Now here's the problem with one of the winners, AbbVie. I own the name. I've been an advocate for the name for almost a year now. But look at where the chart is trading right now. All-time highs, highly extended from a weekly chart perspective, and we have dividends that are about to be paid this week. Are we about to see the action that we saw in ZIM shipping also happening and replicated in AbbVie stock? It is certainly something you want to think about, and therefore I bought some puts ahead of this week. And here's the news for Boeing. We have a DHL plane that's split in half upon landing, and this is not a new founding, by the way, from Boeing. We've been warned last year that we have a problem with new Boeing planes. They have the tendency of splitting in half in stress tests done by the company, and therefore we call it the flying coffin. Likewise, let's talk about Tesla, because Tesla was down big, but we're not really talking about Tesla. We're talking about Elon and his hijacking of Twitter. Because it appears that Elon doesn't have good intentions after all. It appears that Reverend Elon is in a mission to destroy Twitter. He suggested to his followers that Twitter's headquarters in San Francisco be turned into a homeless shelter. He also suggested to change the company's name to Tether. Okay? So what do you think will happen to Twitter stock on Monday? All of these geniuses with the FOMO who chased the move higher, believing in Reverend Elon's scam, yet another one, will eat a massive pie in the face this coming week, because the shareholders are now realizing that Elon hijacked Twitter. He's not a passive, not even an active investor. He is on a mission to destroy Twitter. At least it appears so for now. So you sheepies keep chasing Elon's scams, from Bitcoin to Doge to Shiba to now Twitter. What's next? Tesla? Anyways, let's talk about Shell in oil, because you want to avoid this one. Matter of fact, I sold BP, by the way, because they're going to eat a massive bag in Russia. And I'm just sticking with Chevron right now, along with some of the gas plays. Shell and BP are in trouble, and the reason is, in this case, Shell is about to lose $5 billion from Russia. On top of that, Shell now blaming margin calls for the billions of dollars they're about to lose. Something severely wrong going on with Shell and BP. And the stupidity, by the way, the virtue signaling by getting out of Russia. You think that's going to be a good move, financially speaking? Of course not. There is a price to pay. And therefore, I'm sticking with Chevron and the gas plays the domestic gas plays. Moving on to the weekly heat map for the ETFs. A bloodbath across the board. The winners were the inverse indices, the UVXY, and by the way, you want to avoid the VXX. It's a mess out there. Nobody knows what's going on. They trapped a lot of buyers, and now people are selling on the secondary market. They're dumping VXS shares. You want to avoid this one for now. If you're going to play the VIX, play it via calls and puts on the SPY. Anyhow, when we look at the heat map, we also have winners in uranium up big for the week. Likewise, UNG gas also up big for the week. We're sticking with the commodities for now. Energy ETFs were in the green, the XLE, OIH, XOP, all in the green. Likewise, utilities, the XLU, XLP for staples, the XLV for healthcare, but specifically Big Pharma was big in the green, the leader so far. When we talk about growth versus value, it's obvious that value outperformed growth this week. Growth was down big. Look at the IWF, down over 3%. Meanwhile, the VTV scoring gains of almost 1%. International markets pain across the board. Chinese, Brazilian, Asian, European ETFs all down. Nobody won here. But the majority of the pain in ETFs came from the SMH, the SOXX, anything chips got crushed severely. The SMH is down over 7% for the week. And I tweeted this today. Chips suffered a major blow this week. The SMH is down 7%. NVIDIA is down over 13% for the week. Remember that Brian Deese from the BlackRock administration gave us a major warning to get out of chips when he said that the US will lose 1% of GDP from the shortage in chips. And by the way, who's been telling you to get out of chips in the fourth quarter of last year? The answer is the guy you're listening to right now. I tweeted back in November, I think the winners in chip stocks are topping. I'm buying puts on NVIDIA, on Xilinx, on AMD, on Qualcomm. And these names are down big since then. Anyhow, let's move on to charts, and we start with the SPY, the S&P 500, 30 minutes chart. Nothing to see here, and the reason is the chart is still trading within a range. The support at 446.5, the resistance at around 451. The good news for the bulls is the following. The chart went down and retested 446.5 as support, and it made it at the end of the day by closing above that number. Had it failed, closing below 446.5, we would have said the bears are making progress. Watch out, 443 is not going to hold, and sooner or later we'll be down at 430. Now, that might be the case in the long run, the eventual case, the SPY would go down to 430. But for now, the bulls have some hope to fight on, that they kept 446.5 as support. Now, the problem for the bulls is, what if what we're seeing all in all is a formation of a bear flag pattern, and sooner or later the chart will play out the bear flag pattern and we will see 443 broken as support. Then that gets us all the way down to 430, which is the strongest support left after 443. But we're not there yet, so we have to zoom out to a daily chart for the continuous contract of the SPY. What do we see here? The good news for the bulls is they're keeping 4,472 as support. The bulls could argue that what we're seeing right now is a pullback, a natural pullback after an impressive rally, and then we will see the rally resuming again. All of that is good until you lose 4,472. But the most important level the bulls have to watch out for is 4,384.5. Once you lose that, all hope is gone. But for now, we have a low volume week. This is the assumption. Due to Good Friday, we're not going to have trading on Friday, by the way, so that could be a bullish factor to keep the indices higher. The problem is, we have a lot of macro data, specifically the CPI. We also have banks' earnings, and that could be a negative surprise. And what if oil prices continue to go down? Remember, part of the resiliency in the SPY versus the Qs is the fact that the SPY includes energy. What if energy starts to weaken due to the increase in supply via the SPR? And on top of that, the recessionary talk and the lockdowns in Shanghai. What if energy starts to underperform? And on top of that, technology, software, the high multiple names don't pick up the tab and start moving higher. So we could see the SPY also falling apart, just like we're seeing in the NASDAQ. Here's a daily chart for the SPX, the cash index for the SPY. The chart is barely on the 200 days moving average. It did not close well below the 200 days moving average for us to say it's over. We also have a gap, and these charts have the tendency to close the gap above, so we're not going to call it the end of the road here for the bulls. They could initiate a comeback this week with the assumption that it's going to be a low volume week because we have shortened trading, but we also have a lot of macro data and banks earnings. So it's not in the bag that we're going to see lower volume. This is just the assumption. But if the assumption is right, the bulls could go all the way higher to close the gap, and then we'll take it from there. If they fail to move higher, then we have a shorting signal, and the shorting signal will be confirmed once the SPX crosses below the 200 days moving average once again. What about the Qs? 30 minutes chart. Unlike the SPY, the Qs lost the battle of 352. What does that mean? Next, we're going down to 343, which is the most important number for the bulls to keep. If they lose that, we got a problem, a major one. Perhaps the Qs will make a lower low, so watch out for 343. Now, could the bulls use the low volume week, the shortened trading week, to initiate a rally to close the gap and recapture 352 as support? That is possible, but it's not the consensus right now. At least not right off the gate on Monday. We have to wait and see how the slew of macroeconomics data will be received by the indices. We have to wait and see till we get at least JP Morgan's earnings out of the way. And if all of that is good, then yes, the bulls could stage a rally to close the gap and recapture 352 as support. It's a long shot, but it could happen. Now, here's a daily chart for the continuous contract for the NASDAQ. The problem, unlike the SPY, is the fact that the NASDAQ lost 14,445. And the line in the sand right now becomes 14,000. The volume is moving higher in the wrong direction for the bulls, meaning on the selling side. The momentum indicators are moving down in negative divergences. This is not a good sign for the bulls, good sign for the bears. So the assumption for now is for the NASDAQ to go down to 14,000, and then we'll take it from there, whether that support is going to hold or not. The consensus for now is not for the NASDAQ to recapture 4,445 as support, but it is actually to go down to 14,000 and retest that support. And the bulls, by the way, should be cheering for that scenario. Why? Because let's say on Monday, right off the gate, the chart moves higher and recaptures 14,445 as support. And then later in the week, due to a macro data or an earnings report, the chart loses 14,445 and we see a flush down. So why not retest 14,000, make sure that is solid support before we move higher? And here is a weekly chart for the continuous contract of the NASDAQ, absent of the drawings and the markings, with the exception of the trend line. What are we seeing here? We obviously have a support bounce from the trend line, but the momentum indicators remain in negative divergences. That's number one. Number two, what if this is a formation of an ABC pattern? And sooner or later, the NASDAQ would lose that support. And here's the monthly chart, by the way, for the continuous contract of the NASDAQ. Look at the MACD indicator. It is already confirming the negative divergence on the RSI. We're seeing red impressions on the histogram. And the formation for now is a bear flag pattern. The monthly chart is more significant than the weekly and the daily. And the monthly chart is suggesting trouble ahead. What about the IWM, the Russell 2000 small caps from a 30 minutes perspective? Nothing happened here on Friday. We have a confirmation that the IWM lost 204.5 for good, but it has yet to lose 196.5. Does it look good for now? Of course not. And here's the evidence. When we zoom out to the weekly chart of the RUT, the big Russell 2000, we have a solid rejection at around 2100. The most important line for the IWM bulls to recapture. Well, they failed to recapture it right now, at least for now, but it doesn't look good for them. It looks that they don't have the energy, they don't have the fundamentals to climb above 2100 again. What does that mean? If you cannot move above 2100, you have to go down to the next support. The next support, folks, is way down there. We're talking about 1500 kind of support. You better watch out. What about the Dixie, the dollar index? What's going on here? It appears that it is topping. We don't have a confirmation yet, but it got to my target at around 99.9, and it is stopping here. We also have a negative divergence on the RSI, so sooner or later, the dollar is going to top. And by the way, we have the DeMark, folks. I don't believe in any of that voodoo science, but it works once in a while. And the DeMark indicator says the dollar has topped. And if that is the case, then shouldn't gold rally higher? Well, you gotta remember, gold has two enemies. One of them is the US dollar. The other one is the 10-year yield. Even if the dollar goes down, gold wants to see how the 10-year yield behaves. If the 10-year yield goes down along with the dollar, it will be a massive green light for gold to rally. For now, gold moved a notch, a little above 1,950. Or 25, I should say, and this is a good sign, not a bad one. Likewise, the MACD indicator is curling its way higher, about to cross, creating positive momentum. Is this bullish or bearish? The answer is it is bullish, but we gotta wait for the confirmation of a top in the US dollar, and better yet, a top in the 10-year yield. At least a temporary top. That'll do. What about crude oil Brent? This is a 4-hour chart. It continues to hold on at 100. So far, so good, because Brent could rebound from 100 and stage a rally. The problem is, once the chart loses 100 as support, then we could see the flush down coming. And therefore, at this stage, I am positive natural gas, but not so hot so for crude. Crude gotta show me the money. How do you show me the money? Cross above 105.84, and then I'll believe you. And I'll say, okay, the next stop is 118, and after 118, we go back to 120, 125, perhaps 140. But that's not gonna happen if you lose 100 as support. And here it is, the 10-year yield, the daily chart. The sky's the limit for now, and it becomes a psychological target, by the way, to get to 3%. Are we going to get to 3%, the round number, and then we see a sell-off in the 10-year yield? Perhaps. What will be the catalyst, by the way? Is it going to be the CPI, aka the CPLI, when it shows that inflation went higher by less than expected? Wink, wink. I'm just reading the tea leaves for you. And the confirmation for that would be losing 2.54 as support. And if that happens, it will be good news for the TLT, because when we look at the weekly chart for the TLT, a lot of trouble ahead. The TLT bugs. You lost 128 as support. Yes, the chart's getting way oversold, but I already ate a pie once. I'm not going to eat another one once again. I'm already full. I got to lose some weight. Too many carbs. Cannot afford to eat any more pies. So we're moving on to the VIX 4-hour chart. The VIX continues to hold in this bullish pattern, at least for now, until and unless it loses 20 as support. The MACD indicator is showing signs of weakness, but we don't have the confirmation because the VIX continues to trade above 20. What about the VXN, the VIX for the Nasdaq 4-hour chart? Unlike the regular VIX, the MACD indicator is still moving higher. It is still firming up, showing positive momentum, meaning that the VXN should move higher. Qs should move down. And for now, we have a bull flag pattern until and unless the chart loses what? 27.5 as support. If that happens, bye-bye bull flag. The bulls, meaning the Nasdaq bulls, have another plan. They're staging a comeback. They're taking advantage of the low volume week, perhaps. We'll see. What about Apple, a daily chart? We have a confirmation of the weakness from the momentum indicators. Both the RSI and MACD are now in negative divergence. But on the bright side, we have a gap above. This chart, at least the bulls, will attempt to close the gap, and this will be a good trade, by the way. We're talking about from 170 to, let's say, 175, and then the chart could stall again and lose 172.4 support. This is the bullish outlook, by the way, because for now the chart closed below 172.4. What if the downward spiral continues in Apple? What if it loses the yellow trend line, which happens to be the upper range of the channel? What if it goes down all the way to 157 as support? I don't think that will happen without a fight by the bulls, meaning an attempt to close the gap. Because for now, you have two important scenarios for this chart, which will determine, by the way, the outcome for the Qs. Scenario number 1, closing the gap, and then we'll take it from there. Scenario number 2, not closing the gap and going down all the way to 157 as support. How do you know which one will happen? Well, you got your support lines. If the chart goes down, breaking the support of the upper range of the channel, then you know this chart wants to go down to 157 before closing the gap above. But if the chart reclimbs 172.4 support, then you know the bulls want to close the gap and then take it from there. Tesla, the souffle. This is a 2-hour chart. This is the battle of the gaps, by the way. Which gap will be closed before the other one? Is it going to be 1,090.5 or is it going to be 995? On Thursday's video, I said it is likely for now, the most likely scenario is closing the gap above at around 1,090.5. But this took a massive hit on Friday. We talked about the bear flag pattern. Well, now the bear flag pattern is playing out. On top of that, it was a psychological defeat for the bulls we're talking about souffle bulls. Why? We got out of the Austin Gigafactory event. We got out of the pumping from Elon Musk, the Cybertruck, the robo-taxis, the flying condoms, whatever it is. And all of that did not work. It wasn't enough for the bulls to close the gap above. And now the bears become emboldened to close the gap below at 995. So the case for the bulls got a lot weaker, and it's now, at least appears for now, that closing the gap below at 995 is the likely scenario until and unless the bulls stage a comeback early this week. Moving on to BTC, tulips, what's going on here? We're taking the bull flag out of the picture because it doesn't even look remotely as a bull flag anymore. It is just a matter of time now before BTC loses 42,000 as support. And if that is the case, we're going down to 35,750 as support. Another trap? Possible, but we're not going to lose hope for now until 42,000 is lost as support. And lastly, what about AMC? This is a 2 hours chart. What a heartbreaker for the apes. They thought they got it, and what do you know? This is yet another pump and dump scheme in AMC. A lot of people bought calls, a lot of people bought the stock, and unfortunately, they're now holding the bag. The chart lost the most important support at 21. It could stage another comeback and retest 21 as resistance, but it's not a good chart to be in because you got the pop, you got the initial pump, you got the spark. But the apes failed to follow through. They failed to buy calls, they failed to buy the stock, and therefore, it was just a pump and dump. People bought calls, they closed them right away. The market maker did not hold these shares for too long because when you buy calls, the market maker has to buy the underlying shares. But at some point, the market maker looks around and says, hey, any buyers? Any more to this pump? No, nobody? Okay, let's dump the shares and goodbye. And this is what happened in AMC. Moving on to the conclusion of this video. What do we have on the earnings calendar this week? On Tuesday, we have CarMax. Why is this one important? I used to own the stock, by the way. It was a beneficiary of inflation in the early stages because they had an inventory and they were able to sell that inventory at a markup price. But you get to a point where they now have to buy new inventory and now they have to pay top dollar for this inventory. So the input cost went higher for CarMax, Carvana, all of them, and the margins are getting hit hard, and therefore I got rid of the stock. But it is an important indicator for the upcoming CPI when we talk about used cars prices. Likewise, we also have Albertson. This will be a good indicator for food inflation. What are they seeing in the supply chain? Are they seeing higher prices or perhaps peaking prices? Are they seeing a shortage of food or an abundance of food? We will know that once we get the earnings from Albertson. Wednesday, we have Delta Airlines, and this will be important. Why? What is the impact of jet fuel on the bottom line of these companies, the airline companies? Are they able to pass the cost to the end consumer? Is the consumer traveling more? Because if they're not, you cannot pass the extra cost. We will know right away by looking at the margins of Delta. But perhaps the most important earnings will come out JP Morgan Chase and BlackRock also reporting on Wednesday. JP Morgan Chase is down big year to date, and they already warned us that they're losing at least $1 billion from Russia. Is there more to that story? Is the Landromat hiding something? What about BlackRock? BlackRock is set to lose even more than JP Morgan in Russia. We talked about that in details in a previous video. So we could see fireworks on Wednesday. And lastly, on Thursday, we have Goldman Sachs. Whatever happened to JP Morgan will happen to Goldman Sachs. I am a shareholder of Goldman Sachs, but I'm buying a lot of puts, and the reason is the trading mania is over, so the revenues for Goldman Sachs will be down, that's for sure. Yet the stock is down big year to date. So could it be the case that it's too bad it's good? We'll see. But what is the harm in buying calls, specifically if you bought them cheaper when the VIX was below 20? See what I'm talking about? Anyhow, what do we have on the economic calendar this week? Monday, April 11th, we have the 1- and 3-year inflation expectations in New York. We also have Chicago Fed Zombie Evans speaking. Tuesday, April 12th, we have the Small Business Index, and most importantly, the CPI, aka the CPI. And boy, the kitchen will be busy, busy, busy. Likewise, we have Governor Braindead speaking once again. Is she going to clarify the remarks from last week that caused the market rout, or is she about to double down? We also have another Fed zombie from Richmond, Tom Barkin speaking. And then Wednesday, April 13th, we have the PPI final demand. And on Thursday, April 14th, we have the initial jobless claims, retail sales, the import price index, the University of Michigan consumer sentiment index, and 5-year inflation expectations. We also have business inventories, a more Fed zombie speaking, this time around from Cleveland, Mr. and Zombie from Philadelphia, Harker. Lastly, on Friday, April 15th, we have the Empire State Manufacturing Index, the Industrial Production Index, and the Capacity Utilization. And a reminder, trading will be off on Friday due to Good Friday, so we're off on Friday. It is a shortened week. Will the volume be down as we expect or not? Because we have a lot of impactful events on the macro calendar, and on top of that, we have earnings. Expect the unexpected. With that, folks, I'm done here. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.